Welcome to the Dividend Talk podcast, episode 37. It's a marathon, not a sprint. Hey guys, welcome back to another episode of Dividend Talk. I'm your co-host, Engineer My Freedom, and today I'm joined with European DGI. This is a podcast where we discuss our passion for dividend growth investing with our own unique European flavour. If you're new to this channel, please hit the like button and subscribe to us. And check out our previous episodes on YouTube or Spotify. See you on the inside. Another week, more earnings coming your way. How are you doing, European DGI?
Well, like you said, it's really a marathon, but don't you love being an investor in these times? I mean,
this must be our fourth week in a row where we're talking about earnings. I mean, you have to have some dedication to really enjoy this. I mean, if you don't like reading reports, then you can't be a dividend investor, really, can you?
yeah, but for me, it's like it's just oil on the fire for me. It's like my passion and reading all this stuff. And to be fair, I have no time to read 100 pages every day with reports coming in. But for instance, I was today reading one of the reports, and then you see, I think I posted on Twitter about Walter Kluwer, and then they write about their expectation, for instance, for the dollar currency, where they make an estimate that the currency will be around 121 or something like that for the average of the year. And I think like, wow, that's like a 10% further weakening of the dollar. And these are the little nuggets that I really love when I'm reading, because you really get an insight of what the accountants are thinking. And then you can wonder, like, why do they predict this? Is it then again the interest rates, or is it the money printing? Why are they so conservative, right? So this is really what I love about reading these reports, all these little nuggets.
Yeah, and I mean, again, for people that are strapped on time, the presentations are fairly helpful. If you don't have time to read the reports, the presentations are great. I know we do like quick takes, so some companies where we don't dig into the earnings, and it's mainly just the presentations that we skip through. So I quite enjoy them, but I have to say we had a look just before we came on at Medtronic's presentation. Man, they need to hire somebody to just pay someone a couple of €100 to do a decent presentation for them.
Yeah. I mean, they should hire Dividend Wave and let him do this because I know he will do a 10 times better job, because the Medtronic presentation is horrible, really horrible. I think it's done by a graduate or something like that. And I think that would be even with disrespect to graduates. It could have been my son. Yeah, could have done that.
So Dividend Wave, if you're listening, there's a job position there waiting just for you.
Yes, exactly. And if you've done Medtronic, then go to Procter & Gamble. You can redesign their whole website as well.
So let's talk some news. I think the big news this week has to be AT&T. I know a lot of people out there are waiting for the rant from European DJI. So take it away.
Well, what can I say? I mean, this doesn't come as a surprise, right? I think back in September already, I read a news article that they were intending to sell DirecTV for 16 billion, and we started already counting at the time, like, whoa, that's a 50 billion write-off. And then we saw the other time, I don't even remember anymore, in the last quarter, they did a huge write-off as well, or it wasn't the annual report, right?
Mm-hmm.
And still they increased the debt. But this one, wow, this is like, there's just nothing left almost of this investment. It's like literally down the drain.
Yeah, yeah, money just into thin air, just gone.
Yeah, if the CEO ever talks again about creating shareholder value, we should hanging up because, come on, this is like, what is it, 50 billion gone? Like,
yeah, I
what
mean,
can you buy for 50 billion still?
That's nearly a loss of 88% on their original investment. It's ridiculous. But I believe they're not even getting rid of all of DirecTV. So TPG isn't buying a stake in the Latin American or the regional sports networks, so they must be staying with AT&T, I believe.
Well, I don't know if that's a good thing.
No, no.
Should give it for free with it, I think.
But at least from an investor standpoint, look, it's taken off the books. We won't see them in their consolidation statements again going forward. They're going to use this 8 billion to pay down some debt. But I mean, I had to laugh. The CEO came out and said about their strong balance sheet. I mean, I don't know what balance sheet he's looking at, but it's certainly not strong.
Well, someone with the name Stanky or Stinky as a CEO is not someone we can trust, I think. And I find this always really funny, like all these last names of CEOs and something. Sometimes I think they really are chosen for their last name.
Yeah, it's like a music artist, isn't it? You just make up a name to be a CEO. It's not your real name.
Yeah, exactly. I think so. And maybe that's a good thing as well, because if otherwise you get these Twitter folks like myself that are making are being a pain in the ass to them online. So
So yeah, so that's really the big news this week. I'm kind of happy as an AT&T investor. I'm kind of happy that this is now done and dusted. I think it'll be finalized in the second half of this year. Get that monkey off their back, accept a huge loss, and just move on. And hopefully they don't go buying any other silly companies anytime soon.
yeah, so what for me is the issue then is probably what you will see. You will see the write-offs again, yeah,
Hmm.
which means that their equity side of the balance sheet probably also gets reduced, which means again that their leverage becomes higher, their debt to equity ratios. And now we are still in a bull market, right? But when shit hits the fan, there comes just way more pressure on the balance sheet in these cases. And I've seen this more often in the past, where a company can almost go bankrupt because and I think it's not with AT&T. I think it's far away from that at the moment. But just for general information for the listeners, like if you have these large write-offs, then I don't know how you call this in English. This is bank covenants, these contracts that banks have for your debt. So okay, so I don't know what the word is, but they often in these contracts they write like, okay, if for instance your debt becomes above a certain rate of your total asset value, or let's say the high rate, then they can increase, for instance, the interest. They can
Okay.
ask more because the risk is increasing on the debt. Yeah, and this is the issues that these kinds of companies get into. If the debt stays the same, but for instance, the goodwill gets written off for the assets, then there's less asset left for the debt, and then the banks can start getting worried and think like, you know what, let's quickly increase the risk profile of this company and ask more money. So this is, I think, the balance, the thin line that AT&T is walking on, and the CEO can say whatever he wants. I just don't treat credit ratings in America, because what I often see is that I'm looking at brilliantly managed companies in Europe with a really sound balance sheet, and I see that they start with a B rating, and I see crappy companies in America with an A rating starting.
Yeah.
So I never trust these rating agencies anymore. There must be some politics there, but investors need to be aware of this. That this is not kindergarten, right? This is real money.
Yeah, and you have to remember we're still in a low interest environment. I mean,
Exactly. And then with AT&T,
so what happens when interest rates start, and look, I suspect they will, but what happens when they do start rising? It puts a serious amount of pressure on their balance sheet, and like you say, if the bank comes calling and they want to increase interest rates, they're well within their right, because that risk is just too high to take for any bank.
yeah. And what I think what the guy also said, the CEO, is that like they have made new deals about their debts. So effectively, some cheaper deals in the upcoming year, or let's say prolong their debt to later dates. But it's just like postponing it. Yeah. So in the end, they need to pay the bill one time. So, and they need to do that with cash flow. So I think they're really juggling with that. And I guess they are betting everything on 5G now, and let's see how much they overpay for that again, because that's the only track record they have, is overpaying for things,
Yeah.
even for
Five,
the dividend.
yeah. 5G is the holy grail for them. It's make or break. So, interesting times, but I mean, it's positive they finally get DirecTV off the balance sheet for
Yeah,
now, and
exactly.
we'll see how they go this time next year.
Yeah, what I like at least then to close this out is that the CEO is active. This new CEO, he's really cleaning up the mess that he inherited. So that's what I'm. That's a good sign, actually.
Yeah, cool. So we have lots of European companies to talk about today, which is good because we're European investors. But we might start with one of the American ones, Realty Income, maybe the monthly dividend paying company. Actually, I'm quite annoyed, not with Realty Income, but with the Gyro at the minute, and I can't seem to get a decent answer. So maybe somebody out there might know. But I can't buy any more Realty Income on the Gyro. I know they're having some issue with investment trusts and tax reasons, but I haven't got a concrete answer. So if anybody knows, drop me a DM of why I can't actually buy some. But looking at their annual report, they've had a decent year, all things considering. I know REITs were under pressure due to COVID, particularly rents due and stuff, but their revenue actually year on year increased, which is quite surprising. And in turn, then their net income increased. Their funds from operation also increased and beat expectations. Um, and for me, they collected, was it 93.6% of the rent, which is pretty big. From their investment grade clients, it was 100%, which is always good. And then from their top 20, I think it was like 89, 90%. So it's quite a solid year. They've invested nearly 2.3 billion in new real estate, which I didn't really expect this year, including 921 million internationally, which is also good. So I'm not sure where. I haven't digged into that, but I'd like to see him a little bit in Europe actually, just to see him get a little bit more exposure over here. But all in all, it looked a pretty solid report to me. I mean, we know that they're consistent with their dividend. It was a 3% increase year on year, and I don't expect that to change anytime soon. I just kind of wish, I know that price dipped a little bit during the week, and I wish I could add some more, but I can't on the Gyro at the moment.
I think they knocked it really out of the park. I mean, COVID-19 year with so many businesses being in trouble, and they have some gyms and such. It just shows what a management quality they have, that they are able to pull this off. I'm really impressed with these numbers, and I think I said the share price deserves where it is. It's a bit on the pricey side, but I think that's what we pay nowadays for high quality. So I'm really impressed with these numbers. Okay, so that was a nice one to start up with and warm up with, let's say. So I looked in one of the biggest European chemical companies called BASF. It's a German chemical company, and I don't know how many people have it in their portfolio. Probably some of our German listeners have it. So I own some shares in that. I think 50 or something like that, and for me that's half a position. I'm trying to add an additional 50 anytime soon again. And I was actually quite impressed with their numbers because, it has been so hard for these kinds of industrials during COVID-19, right? For instance, just transport and business with China and such came to a halt last year. So if you then look at it, they made around 59 billion in sales last year, which was effectively flat. But their costs were rising during the year, so which meant that their EBITDA, or let's say their earnings before interest and taxes, dropped with 23%. If you now look at the numbers, you will actually see that at a billion loss, pure in net income. But that's because they had to do an impairment of 2.9 billion on their property, plant, and equipment. I've looked that up a little bit, and what it has to do with, for instance, one major site that they have. Also due to the expectations in the oil prices and the commodity prices, they just looked at the reserves and did a revaluation of that last year. Because remember, even the oil prices, drop below zero. So we saw it already with ExxonMobil, we saw it already with Royal Dutch Shell, and BASF effectively did the same. So it's a non-cash impairment that they had to take. So what then is important always is to look a little bit at the cash flow, how that looked like. And the cash flow was a little bit comparable to their EBIT. So they had 28% less cash flow from operating activities. But that's nice because it's a bit of a cyclical company and they did quite well. And what I'm really happy with is that they kept the dividend flat at €3.30. So that means that today you can pick a BASF for almost 5%. 4.9% at the moment. And you need to know that their goal is to grow the dividend every year. And this is one of those few European companies that's really explicit with their ambition in the dividends. So because of this extraordinary year, they kept it flat. And the last time they had to cut the dividend was back in 2009. They did it around 10%. I once checked the numbers, and at that time they were not really so focused on growing their dividends. So I find it just a sign of strength, and specifically after we know that Danone did like a whining cut of 8%, and one of the companies we will next talk about as well, small cut. So I found these numbers really strong, and what is nice actually that their sales outlook for 2021 is quite optimistic. So they expect sales growth towards 61 to 64 billion, which would be a few percent again, just in sales, which usually lead to quite some, improvement also in their earnings. And they're expecting earnings before interest and taxes to be between 4 and 5 billion, which would be literally 10 to 15% minimum increase from what they reported in 2020. So I find the dividend very safe. It's a high yielder in Europe, almost 5% for a chemical company. So there are so many nice companies at the moment to pick up. Unilever, Ahold, we discussed the other days. BASF is also on my radar. I have to less cash just to choose from these. So yeah.
I'm really glad you brought these guys up. I actually have them on my short list of companies to write about or to look at. In my portfolio, I'm really shy on industrials and materials, and this was one of the companies that I've shortlisted to look at. So I'm happy you've included them here, and to see that their numbers have performed as good as they have. A dividend yield of nearly 5% seems to be then that they are nicely priced at the moment. That's just based off dividend yield and nothing else. So don't take that as any advice, but it's nice to see that they are committed. I mean, as you say, not many companies, European companies, commit to growing their dividend. What's their did they give a target payout ratio? Is it around 50%, 60%, or?
I don't remember. The
Okay.
main thing I know is that they want to grow their dividend every year. So I think, no, I don't know.
Okay, yeah. No, I'll find out when I'm reading. But usually European companies have a percentage they want to hit, and they try and stick to that. So it's useful to know. But no, thank you for that. It's definitely one on my radar, and I'm more intrigued now than I was before. So it's good. So we'll move on to one of our Spanish companies, Red Electrica, and hey, I think you've got some like mystic powers, or I don't know if you can tell the future, because you just seem to be hitting companies, their predictions bang on, particularly the last 6 months or so. And I remember reading your article, and if I remember correctly, it was titled something about a high dividend yield, but at what cost? And you were talking about the pros and the cons, and you were quite concerned, particularly around the regulation, the Spanish regulation that was incoming. And you did predict a dividend cut, but I don't think you expected it so soon.
That's true. I expected it around 2024. And
Yes,
why did I expect that? Because I believe Red Electrica will need to renew their assets by 2024. So effectively, they got a lot of old steel there, and they need to revamp it, and that will cost a lot of cash for them.
yeah.
And they also had no approval yet from the regulators about their strategy at the time. So yeah.
Yes, the regulations from the Spanish authorities seem to have hit them hard, and that's quite apparent throughout the whole report. Um, what made me laugh is that on the first slide that I looked at, it had highlights, 2020 highlights, and then the heading underneath it was COVID-19. I was like, how, how is that a highlight? So
Yeah.
you know it's not going to be a good report when it starts with that. But just to run through some of the numbers, so their revenue was down, and EBITDA was also down. It was about 1% below 2019. EBIT was down 14.2% compared to the previous year, and then their profit for the year was down 13%. So quite big dips. They do associate most of that down to the new regulations from the Spanish authorities. COVID didn't have too much of an impact on their business apart from their satellite activity. So, I mean, COVID can't really affect utilities as such, as everybody needs electricity. If anything, I would have expected them to do a little bit better on that side of things. But it's this new regulation, and the one thing that really concerns me is their free cash flow. So their free cash flow for the second year running was not enough to cover the dividend. So I can understand why they've cut the dividend. I think it was by 5%, but I don't think it was enough. There's definitely another dividend cut going to come next year and possibly the year after. You mentioned just before the show, I didn't see that they have a floor of about 80 cent. But look, at the moment, it's still a juicy dividend yield. It's still 7.32%. They're fairly priced for what they are. But as a dividend growth investor, they're not as stable as they once were. So they had 22 years of pretty good solid growth, but that's gone now. I can see it declining for the next 2 or 3 years, and it's not going to. I don't think they'll cut the dividend, but it's just not going to grow like it used to. So, um, for me, I have a position in them. I own about 100 shares, but I don't know if I want to keep them now or not.
Yeah, so I've got the same. I've got also around 100 shares. It is a tier 4 company, by definition, really small, and I bought it purely for the yield. And I will probably sell it in the upcoming months. I don't know exactly when. I might just sell it once I see another opportunity. For instance, I'm Ahold. I mean, after the price dip again now in the 21. So maybe I'll just sell my Red Electrica and put it all in Ahold or something like that. Or I will just sell some covered calls and then start to earn some money with that. So
Yeah.
it will be a bit of play money probably for me.
What I find in my head with European companies, right? So they pay out dividends maybe once or twice a year. So when you hold a company like Danone, for example, and they've really annoyed me with their 8% dividend cut, and I've mentioned that and consider selling them. But then on the other side of things, I'm like, I've been holding these now for 8 months. I haven't got paid from them once. I'll just hold on to one until I get the dividend, and then it's whereas
Yeah,
with European or US companies you get paid once a quarter. So if you sell them, chances are you've already got dividends from them. So it's a mental
yeah.
thing in my head. So I'm looking at these going, oh, okay, the dividend's not safe, but I might sell them. They're not going to cut the dividend between here and the next time they pay, so I might just wait until I
Yeah.
get that and
Yeah.
then look to sell them.
Yeah, so the question with Red Electrica is then now is the turnaround in the share price, right? But to be fair, so I don't have a strict rule to cut the dividends straight away after. That's why I'm not going to sell Danone for now. But with Red Electrica, I just don't see a future at the moment. I don't see a catalyst, and which is different. Danone, I see a value play really, but with Red Electrica, I don't see it. So that's why I think I will just sell it in one of these days and then put probably all the money in Ahold.
Yeah, but I suppose the difference is Red Electrica are held by the Spanish authority. Like they've no control over this. Like when these regulations are passed, they've no real control over something like
So
that.
it was trying to diversify away. You mentioned the satellite business already, right? So
Yeah,
it was purchasing assets elsewhere. The issue is with, for me, such a utility, you buy it for the yield. Yeah. And if
yeah,
that's not even safe anymore, then what's left there in your investment case for a company like Red Electrica? You expect predictable growth, usually in utilities because of the regulatory environment, but that's not even here. So there's just
yeah,
nothing in this company anymore that for no reason anymore for us to be in.
yeah. They'd really have to start expanding their international exposure a little bit more to maybe
Yeah, but
try and
for that they need cash.
yes,
Yeah, and
yeah,
they are heavily in debt. So
yeah.
yeah.
It's not looking good for them, to be fair.
Okay, so let's move on to I mean the fourth company then. And it's funny, we had a real estate company, an industrial, a utility, and now we go to an insurance company because I want to talk little bit about Munich RE and reinsurance. You're a bit familiar with that one because we had a full analysis one time on our show.
Yeah.
And what is nice to see is that this company just did really well given the circumstances. So their profit over 2020 was 1.2 billion euro, but we all know that they had quite some impact from COVID-19, right? And where the impact, how is it, really was how you said the property casualty reinsurance. So they had almost a 3 billion, how you said, pandemic related loss to that, and the other 370 was with life and health insurance. So 3.5 billion due to COVID-19 or pandemic related. It's just a lot. For me, these are rather one-off because this pandemic is probably once in a century. So actually, from that point of view, I think they've done really well, and they kept their dividend flat at 9.8 billion. I think this is the 48th year that they're paying a dividend that wasn't cut. They have
Hmm.
frozen it a few times, like in the Great Recession in 2008, 2009, I believe.
Yeah.
Now, but this is amazing, 48 years, and they keep just doing it, right? So for me, the numbers were really good again. And what really is really promising is their January renewals showed a premium growth of almost 11%. And remember that in the show when we were talking about Munich RE, we were predicting this. We said
Yeah.
after a pandemic, it's a perfect time to increase the risk premiums because people will think like, oh, better be insured for when this happens again. And of
Yeah.
course, there won't come a second pandemic straight away after that. Maybe another wave, but I don't see an Ebola virus now kicking up again, like a double whammy. So perfect situation for this company to increase their revenue now.
Yeah. But my only issue with Munich RE is they're still a little bit expensive for me. I'm waiting impatiently on the sidelines to try get in on them, but they're just a little bit too high for me. But I mean, like we predicted, insurance companies I think will have a really good year next year directly from this. And like this wasn't a bad year by any stretch of the imagination. So no, it's a good year. I just want their share price to drop under the 200 mark, and I'll be happy.
Yeah. So I had the luck last year in March or April to buy it on the dip. I think I bought some. I think my initial share price cost price was 150, and then last year 170. So I've got a good cost.
Yeah,
And this is this company. It dips just from time to time. So um, this company is one about having patience.
yeah.
Um,
A boring company that is resilient and predictable. That's what we love.
yeah, a good German company here. And then actually the second one, right, with BASF first. So it's nice to see how the companies are holding up there.
Yeah.
Okay, shall we do some quick takes then?
Yes, yes. Why not?
Okay. So let's talk about another Spanish utility, yeah, our global energy company, Iberdrola. And I know that this is quite many investors on Twitter and social media as well, they are quite fan of Iberdrola, specifically from the southern countries.
Yeah.
And Iberdrola, they had a net profit of 3.6 billion, and their profit grew again with approximately 10% if you exclude COVID-19 related effects. They invested also 10 billion again, and what's probably good to know for the people that don't know the company so well, this is really one of those companies, if you want to play on the sustainability wave, let's say, then you could think about Siemens with the windmills and production of that. Well, Iberdrola is buying those, and they're one of the biggest energy companies in the world, and they're really specialized in wind power. It's the number one producer of wind power here. So just good numbers, and on top of that, 42 cents dividend per share announced, again an increase of 5%, and they've been increasing the dividends for the last 6-7 years quite nicely. I don't see this as a company that is committed to the dividend growth. Their history until 6-7 years ago was quite bumpy. So that's where I'm still lacking confidence a little bit in this company, because I could see that whenever they get, let's say, a little bit of headwind, I can see them cutting the dividend again. So,
okay, nice. It's definitely a popular one with our Spanish community. I've seen this popping up quite a bit. Yeah, nice. So I'm going to talk a little bit about one closer to home for me. It's Glanbia. I think I wrote a post on these before. It's one of the first stocks I've ever bought. I told you, without any analysis, just because they were Irish. But I've been quite pleasantly surprised at how actually good a company they are. They've had a pretty good full year again, considering all things considering. The revenue was pretty much flat, which we kind of expected. Earnings per share is up, but their cash flow, the free cash flow, is up nearly 80 million, which is quite good. They've kept the dividend flat, which I'm surprised. I thought they might give it a little increase, considering they've stated that they wanted to do that. But look, they haven't cut it, so it's nice to see that. But I think they committed to like 50 million share buyback program, so they're giving value back that way, I suppose. They've spent a lot on their debt, so they've decreased their debt by about 20% over the last year. So it was over 600 million. It's now just under 500 million. So it's quite a good year. Expecting a little bit better growth from them next year. The pandemic would have hit them hard, particularly in the food business. But yeah, no, quite positive, and I'm happy that they were a company I bought blindly without knowing anything about them.
that's what they say, right? Sometimes a monkey makes better investment decisions than a human being.
Sometimes I feel like I'm a monkey when it comes to this stuff. So,
oh, cool. I always like it when you're talking about Irish companies. I can people don't see it that are listening to the podcast, but I can see your eyes twinkling when you talk about them. So it's cool to see.
I like Glanbia because they are close to home, but they're a company that I've worked in and around. I always know someone working for them. I like to see them do well. In my region where I'm from, they have right on the riverbank. They have a nice factory there as well. So a lot of local people working there. So I love seeing companies like this do well, and the more Irish companies, the better.
Great. So then let's go to the next one. Then it's a diagnostics company or medical equipment, Medtronic, and for me, their report is just poor. So let's start with the main number. Their diluted EPS, earnings per share, declined with 10%, more than 10%, from 144 to 129. You need to remember that the share price is now. And by the way, I'm talking here about Q3 numbers because they have a different earnings calendar. So these are not the full year numbers. That's important to mention. But their share price is around $116, right? And it's really, really expensive. I wrote also one time a post about Medtronic, and I find it already for a year just heavily overvalued. And their gross margin declined from almost 70% to 67% because their costs really increased. There's just not a lot a lot that I like in their Q3 numbers. Really not, and it was not the most difficult season they had of the whole year. Let's say their operating profit declined with 11%. So I just found it, bad report, a bad performance overall, and I don't understand why the share price is keeping up. It should be below $100 at least, in my opinion.
Maybe that's why they've produced a shitty presentation, because they've lost money this quarter.
Yeah, maybe that's the reason. But yeah, no, I think I own this company. I find it a really beautiful company. Yeah, with the products that they have, the markets that they are in. But I don't find it an interesting stock because of the stock price. I own a position in it, but for me, ideally, I think their valuation, if I remember correctly, for me is in the high 70s, and it's now 116. So it's a huge gap, for me to be interested in it.
Yeah, I did a valuation. I'm a bit lower than you. I think I was nearly closer to 60 than 70s, and they just seem massively overvalued. Like you, I love what the company does. They have a head office up in Dublin, which is good, but it's one that I've just kind of swept aside until they come back to a valuation that's more realistic.
Maybe in 10 years from now.
Maybe.
Great. So these were our quick takes. I hope that everyone enjoyed it again, that everyone feels a little bit up to date again on some of these European stocks. More to come, I guess, next next week again. But yeah, let's go to some of the listeners' questions. I saw some really nice ones incoming again. And the first one, of course, like always, is from our, we could call him the, how is it? The listener with the most questions ever for Dividend Talk, and that's good old Phil Segler. So, EMF, for you, how did your risk tolerance develop over the years? How did the size of, for instance, your standard purchase orders develop? Is it still as in the beginning, or are you throwing more cash at it at the moment if you buy something?
Yeah, it's a great question. My risk tolerance kind of came from the days when I used to try and trade or do that kind of thing. I figured out quite quickly what my risk would be, and now I'm just a monthly investor, and I put in the same amount every month, and I'm quite happy with it. I have money aside, that like my war chest to put in, and I just invest what I can afford to lose, pretty much. And that's the way I look at it. Like, the money that I'm investing now does not impact my lifestyle one iota. If I was to lose it all in the morning, I can still live the life that I'm having. I couldn't retire early, but I'm happy. So I don't look at the number 1K, 2K. That doesn't bother me. I have money aside, and I just put the same amount in every week.
Yeah, I have the same. And actually, I can imagine why he asked this as well, right? So one's risk tolerance, but I put usually my whole monthly salary in one stock, in one single stock, and per month. And that has to do mainly with the commissions that I had to pay from the past. So that's why the habit was shaped. But now with the hero, American stocks are so cheap that sometimes I just buy half of this and half of the other, just to, if there are too many nice stocks out there. And other than that, it's my war chest. But I can say that even if I pull from the war chest, I still have this habit to have have the number around the number that I pay every month for my salary. So let's assume that this 1,000 euros or something like that. I would still pull from my war chest and invest 1,000 euros. I created that habit. That's where my risk tolerance therefore also is around.
Yeah, it's good that you mentioned there, like your thought process and that. And I got that question during the week from somebody, and they're based in the UK, about should they buy one stock or should they buy 2 or 3 or 4 stocks in a month? How should they do that? And I remember when I started, I was following the Dividend Growth Investor, and he sends out 10 stocks every month, and I was buying 10 stocks, but it was annoying me paying so much in commission. So I tend to do that. I tend to buy one, maybe two stocks in a calendar month. And I said the same to the guy on Twitter. I said, it depends on how much you're comfortable with, but try and keep your fees to a minimum. So if you want to invest in 5 companies, do, but just try and keep the fees. Fees low. Cool. So the next question then is from our Danish friend, Dividend Dane. And he asked us, falling in love with certain stocks in both your portfolios and your watch list is very common. Do you ever try to evaluate if there are better options out there? I'm guessing he's talking about Danone for you.
Yeah, I do actually, because I'm also a fan of opportunity costs. So thinking about, okay, if I would sell the known, is there a better option that I can invest the money in? And that's actually why I'm staying a bit with Danone so far, because I think Danone is heavily undervalued, dividend cut or not. For me, the main investment thesis is that if the economy opens again, their water business will return to normal, and that will boost the stock probably really quickly to 80 euros, and then the dividend is nicely covered again. So and the dividend is, by the way, now also nicely covered. So am I in love with Danone for that? Yeah, maybe. If you consider it like that, because I'm really bullish on the company, and I'm not here thinking about that the share price will pull up now. I think the share price will pull up in the new normal, and I don't know when that is, but I'm okay to hold the stock until then. In the past, I fell really in love with Tupperware, and that's where I really made a mistake, and that's where I became blind, and that's also where I took my learnings from. But I'm in love with Microsoft. I cannot be.
I was just going to say Microsoft, Johnson and Johnson. If you took those two companies,
Yeah, I'm in love with them, and I don't know what to do with that. I mean, love also means that you're committed to them, and you don't ditch them on the first moment. And I think if you look at wealth over time and you think about the coffee jar approach, actually most people got rich because of not trading in and out of stocks. So I very much understand the question. It's about opportunity costs. I have this mainly with the tier 3 and tier 4 companies in my portfolio, where I could have that thinking more, but not for my tier 1 and tier 2. I'm too committed to them because I'm buying them for decades, not for years. Okay, so the next question for you, maybe, it's from Piotr. Do you have any rules or hints for averaging down? Because he refers to Unilever buying it on the first drop, and now what to do next? Now the price is dropping further down, or falling further down.
I see this on Twitter quite a bit, and look, I joke around on Twitter, and I have buy the dip emojis all over the place, and one tweet that stuck out to me that I read yesterday was if you buy on a green day, you won't last long as an investor. And no disrespect to the guy that wrote it, but I just think that's a really, really bad attitude to have. I just look at the valuation of a company at a time that I have money to invest, and if they're at a valuation that I agree with, I will buy them. It doesn't matter if I'm averaging down, averaging up, or buying them at the same price. I just look at the valuation at that moment, and if I feel like they're good value, I'll just buy them. I'm not too worried about averaging down or averaging up. Just buying at what I perceive to be good value.
So I have a little bit of a different opinion there, because sometimes we are talking about a value trap or a falling knife, and I had this with General Electric. So I studied my behavior afterwards, and the thing that I did was just that I kept buying on the way down, all the way down, and so to Piotr's thing, what the rules are for me. So I usually I buy in tranches of 10%. So let's say it's 45, I will buy again at 41, at 37. Yeah, but I have also a rule that I never buy, and Unilever is a tier 1 company. I never buy more than, let's say, half of a position in half a year. So for instance, if it would go 10%, 10%, 10%, probably I would. And by the way, this is what I did with Danone. With Danone, I've got half a position, and although it's attractive for me to buy more, I don't buy because I now want to see my thesis play out before I average up probably again. So I put some safety nets in that I never build a full position when I'm averaging down. And preferably around 10% safety nets, safety levels in there.
So we spoke about how to spot a falling knife a couple of episodes ago, and like when you're well, I feel like when I'm doing a valuation of a company, you take that into consideration, the revenue, and
Yeah.
so when I say that I'm buying a company at a fair value, I'm happy to buy that. If my thesis is wrong, it's wrong. So that's why I'm not as maybe strict, but I haven't had that experience that you have had with General Electric. So it might change my mind if that happens, but I'm comfortable that when I do my due diligence and make that valuation, I'm happy in that moment. So I'm happy with my choice. That's
Yeah.
that's what I
And
feel.
Unilever is actually for me an easy stock because I have no doubt around Unilever actually. But still the safety net that I build in for myself to not be blind to risk. And
A company like Walgreens, for example, would be more of a risk than Unilever in a scenario like this. Yeah.
But
Oh,
good question.
good question, and it's good to see we have different opinions on that because lots of people will definitely feel differently. Okay, and we have a question from Tiago DS, and he asked us, what do you think about using profit margins as a proxy to determine how high a company's PE ratio can be before it becomes a bad deal? So he gives an example. Microsoft has around a 36% profit margin. So a PE ratio of 35 might be a better deal than, say, ADM with a 5% profit margin and a PE ratio of 17.
I don't see the correlation between profit margin and PE. So I just look at, Microsoft has a high profit margin, for instance, because it has a large cloud business. So it's really industry specific. If there's anything that I would look at, I would compare with their peers, how the profit margins are. And based on that, decide about the industry PE or something like that. But in general, I don't like to pay more than 20 PE. Although now in these low interest environments, I could do 25. For me, it's just all about the valuation, and the valuation has more correlation than the PE than the profit margin. But Unilever fell with 10% because their profit margins were declining. So what does that say then again? Should we then have a lower PE? So I think I understand what Thiago is asking it for, but I'm not looking at the relation of profit margin and PE at all. No.
Yeah, it's very, very hard to compare Microsoft and ADM in this scenario. Like you, I check across the industry, and you'll see that in my analysis on my blog posts. I use readyratios.com as the site I use. It's very good for comparing these, but comparing different industries and different segments is a little bit unfair. And like you, I don't see the correlation there. But no, good question.
Yeah. And then the last question is from Enzo, Eduardo Garcia, and he asked a question about Ahold Delhaize, so I will answer that one. And he said there were some issues reported related to the pension programs in the United States and the European Union, and he asked, is this good or bad? Or maybe normal? And then he has a second question about why don't European companies need to file something like a quarterly 10K? So the first question, what you see a lot is that pension liabilities are on the balance sheet in the debt sections. Yes, and it's considered debt. So if you want to have some fun, look up the pension liabilities for UPS. We looked into that. What was it, 20-30% of the whole balance sheet, something like that?
Yeah, it's pretty big.
So, I think and I'm saying this top of mind, but I think Ahold did something like a 1 billion or 1.5 billion down payment on the liability for the pension liability. I don't remember correctly. What I liked about why they did that is they took a year where they had enormous cash flow because of COVID-19 related. People were just stockpiling up in the supermarkets, and they used this opportunity of additional cash just to take down their debt profile or lower their debt profile by paying down some of those liabilities. So I think it was a really good move to do that, to use such opportunities of one-off additional cash to just clean up your kitchen. That's what they have done. And then the second question about European companies need to file something like quarterly. So what I know, and I don't know what the regulation says, but if I'm correct, then every company in Europe needs to file an annual report and a half-year report, but not quarterly. And that's why you see a company like Unilever giving a trading update twice a year, and that's Q2 and Q1 and Q3. Unilever likes it because they want to be in there for the long term. They don't want us as investor to know every time what are the earnings per share. So in Q1 and Q3, after that, you only get from them their revenue numbers. And many companies do this in Europe, and I think English companies, especially, I think mainly they report their earnings somewhere in August or something like that often. And they do it also twice per year. So there's no regulation that demands them to do it on a quarterly basis. That's a simple thing. And honestly, I actually like it because it requires us to think more long term here, which I like, which fits my investment style.
Yeah, I think you'll find companies that have ADRs on the New York Stock Exchange may give those additional kind of trading updates, maybe to appease the American investors. But there's no need. I mean, I mentioned earlier they only pay out dividends once or twice a year. They don't need to report every single quarter of how they're doing, and every 6 months is fine for me. And we always say, so sometimes when we see the stock price and we see things happen based on one quarter, and we always say never to judge a company by one quarter. You have to think a little bit more long term. So it does force you to do that a little bit more with European companies.
Yeah. And if there is a severe impact to the business, right, because of an acquisition or a major impairment or something like that, whatever happens, they're still obliged to put a press release out. So it is not like the investors won't get any update about any impactful events or something like that from company during the year. They're still writing press releases for that. It's an obligation. So I think generally we're fine as European investors. It just makes us to have a little bit less to talk about, I guess, every quarter.
We don't like to talk like our American friends.
Exactly.
Sorry, Russ. Sorry. So I think that's all we have. I don't think there's any more questions.
No,
there's not. Cool. So thanks very much for that. It was a long week for me, and you could see I was yawning away and nearly fell off my chair at one stage. So thanks for keeping me awake. Again, thanks to all the subscribers who have left us a review. We've seen another couple this week, and it's really helping us. So if you like the show and you want to support us, just hit the like button and leave a review, and we do really appreciate it. And we will see you all next week.